My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Want to make friends? I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Can trillions of dollars worth of investment be wrong? That's the question we need to ask ourselves now that nearly all the big tech outfits have reported. After a day where the market's rebounded from its lows, Dow gaining 139 points, S&P jumping 1.19%, and the Nasdaq surging 1.69%. All right, didn't make back everything it lost. But, like I said, no one ever made any money panicking. If you panicked yesterday, always a better time. See, there's a whole network of smart, rigorous money managers who do believe, and you hear them on air all day, who believe that Alphabet, Apple, Amazon, Facebook have all become ridiculously expensive, downright dangerous to own. They don't abide by the notion that any of these companies could possibly be worth $1 trillion, let alone $2 trillion. Whoa. Practically every day I hear that these stocks must be hideously overvalued. I'm not kidding. Every day. Same goes for their compadres, Netflix and Microsoft. But that's just not true. I think it couldn't be more wrong. Look, there are a ton of stocks in this market that are way too expensive by any traditional valuation metrics, anyone that you care to name. However, that group does not include Facebook, Apple, Amazon, maybe Netflix, or Alphabet, say nothing of Microsoft. Only Netflix is really the one that I think is a bit of an outlier. See, this is 2020. It's not 2000. That 2000 being the dot-com boom. With the exception of Amazon and Netflix, all these big tech stocks are valued based on their earnings, not their sales. Sure, they may have high-priced earnings multiples than they used to, certainly. But because the stocks are up, maybe the earnings haven't moved up as much, but we're not talking nosebleed levels. Right now, Apple, Microsoft, Alphabet, and Facebook all sell for roughly 35 times this year's earnings estimates. That's been a big leap for something like Apple, which used to sell for more than 15 times earnings before it developed that continual, perpetual earnings revenue stream that comes from service. Before you say 35 times earnings is too expensive, though, remember that these are some of the best businesses around at a time when the average S&P stock is sold around 25 times earnings. So, yeah, they trade a little premium to the average stock, but aren't they better than the average stock? Don't they deserve a premium? These companies are taking over the world. I don't think they're average. I think they're much better than average. Now, only Amazon, let's take Netflix off the table for a second, didn't report tonight. Only Amazon of the companies that reported tonight is an outlier here. It sells for about 100 times earnings. And that's because Amazon has a much faster growth rate than its FANG components. And by the way, it's competing in fields with much larger total addressable markets, or TAMs. I've been using that term for a while now to get you involved, to understand TAM. In other words, those trillion-dollar-plus market capitalizations, they might look insane, but other than Amazon, their price-to-earnings multiples, the traditional way we value stocks, aren't out of whack at all. While Amazon trades on sales, it's also pretty reasonable. It's 4 times sales. It's nothing compared to some of these red-hot cloud plays that everybody's so crazy about. Just look at some of these newly minted IPOs. Snowflake, a company I actually really like, the exciting data analytics company, it trades at 130 times sales. Not earnings, sales. Big difference. Zoom Video, another company I really like, trades for 58 times sales, not earnings. If you want to complain about outrageous valuations, at least use the ones that are priced to sales, not priced to earnings, okay? Personally, I think that something like Zoom will ultimately grow into its valuation because the sales and earnings are rising so rapidly, which is why I like it here. Still, if you want to argue that something's outrageously expensive, Zoom fits the bill, whereas these big tech companies that just reported, they're nothing. They're like American Electric Power compared to Zoom. You know what I mean? Now, here's another way to look at it, maybe a better way, because you have to struggle. You can't just use traditional metrics all the time. Facebook, Alphabet, Apple, Amazon, and Microsoft, they are all what I call proprietary. In fact, they're so proprietary that they often get dragooned to Washington so the legislators can yell at them for being too entrenched and having too much power. I mean, they're these per se monopolies simply because they're the best there is. But you know what? When you hear representatives and senators bashing these companies and making the case for more aggressive antitrust enforcement, they're really just telling you why these stocks are worth buying. These guys, Congress is taking a lot of these stocks to super buy. It's like on their Congress US 1 list. Some politicians may hate big tech for being so powerful and so immunized against competition. But I say, look, this is bad money. It's not mad politics. Good investments. How about another perspective? These big tech plays are generating immense amounts of capital. They're like banks with amazing balance sheets, except unlike the banks, they still have great prospects. Go back to 2000. Everybody's balance sheet looked awful. Look at it like this. Pinterest reported a blowout quarter, and a lot of journalists made a big point, a big deal, about that on their conference call. They said that advertisers are flocking to their platform because it's more gentle, it's more kind than the big social media sites that are being boycotted. Was that Facebook's Achilles heel? I don't know. I looked over Facebook's quarter. I didn't see any problems. I mean, if there's a boycott, I'll point blank call it ineffective. Okay? They have so much cash generation, that stuff looks like a borderline irrelevant situation. Sometimes the bears get philosophical. They'll say, we've seen the mighty fall again and again. 25 years ago, for instance, the 5 largest companies were General Electric, AT&T, Exxon, Coca-Cola, and Merck. Since then, they've become greatly diminished. GE and AT&T, wow, shadow of them former selves. Why? They took on too much debt. Exxon got crushed by the collapse in oil. I should say also AT&T was like landlines. Exxon, I don't know, hanging on by a thread. Coca-Cola, well, that hangs in there because it's got a good dividend, but it's no longer the great growth story it used to be. Merck, still important, although it's lost its edge as the best drug company and has a very low multiple. Could the same thing happen to big tech? Sure, but not anytime soon. None of them have too much debt. None of them are about to be none of them have landlines, so to speak. They still have the best engineers and developers, so they're not like Merck, and they're not natural resource companies that are carbon-based. I mean, it's just not like they're not sugar water. They're not natural resources. Still, we need to consider how vulnerable these companies are every single quarter. So let's delve into them in light of tonight's earnings reports, even though I think that they weren't that significant, except for one company. Alphabet, the parent of Google, was the one company that did something very unusual. They delivered a huge top and bottom line beat, and that sent the stock soaring. Much stronger than expected advertising business, real strength in the Google Cloud, which they're breaking out the valuation of. I always expect Alphabet to somehow drop the ball and scare people, but they didn't this time. It didn't happen. YouTube looks great. This is, as of today, a new Alphabet. Hey, listen, it was up the least of all these. As for Amazon, they obliterated the estimates. What do you even say about a company that earned more than $12 per share? Wall Street was looking for $7.48. I mean, much higher than expected sales. It's ludicrous to see the stock go down big, 37% year over year. The only real blemish, though, while the guidance for the next quarter was strong, their operating income forecast was a little bit light, which is why the stock got dinged a bit after hours. You know what? There was this thing. It was called COVID. It cost them like $4 billion. I mean, don't you, when you have all those employees, don't you think you have more expenses from COVID? Thank you. Facebook, another huge top and bottom line beat, 22% revenue growth. If you thought the boycott would hurt them, think again. Looks like their advertising business is on fire. I love Instagram Shops, what they're doing for small business. CFO David Wenner says that we should expect even faster growth next quarter, although there might be some headwinds in 2021. For now, though, Facebook's looking really good. And what they're doing for the small businessman is never talked about. It's pretty phenomenal. Okay, so how about this one? Is this the worm in the apple? Oh, I like that. Now, finally, there is what we have behind me, okay? Apple is getting hit in after hours, despite reporting a solid top and bottom line beat. iPhone sales were weak, but you've got to keep in mind that this was the last quarter before maybe their most important iteration comes out, the 12, 4 different models. All the carriers are subsidizing them aggressively. 5G. Now, based on the first 5 days of shipping data, CEO Tim Cook is feeling optimistic. Apple's launching a new subscription bundle on Friday. We know the service business is on fire. 585 million subscribers across the company's various platforms. I think the pullback here is a buying opportunity, especially with the 5G launch and the fact that the company didn't skip a beat, even though they didn't have a new phone. That's amazing. And the services business, that is growing like a weed, and they can do it. These guys, the world's their oyster. Oh, they didn't give guidance. Oh, yeah, well, why don't you get me an epidemiologist? They know more. I mean, I got a professor of aerosol at UCSD that knows more than what Tim Cook can possibly say because it's about COVID. Why give a forecast? I mean, unless Tim's taking epidemiology at night or something. Okay, here's the bottom line. After hearing from nearly all the big tech names, the idea that these stocks are somehow ridiculously expensive and dangerous, to me, that's insane. In most cases, the earnings estimates were way too low. That's exactly what you'd expect from the best-of-breed companies that are growing into their enormous market capitalizations every hour, every minute of the week.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.